Now we will understand the impact of currency appreciation and currency depreciation on tourism. Now firstly we will understand the impact of currency appreciation on tourism. When the value of currency of a country appreciates, then it makes a country more expensive for foreign tourists. What it means? Suppose at present we are living in India. So at present 83 Indian rupee approximately are equal to 1 US dollar. So if a foreigner at present decides to visit India, suppose he has a budget of 1000 US dollars and he is visiting he is visiting India, a US citizen is visiting India, what he will get in return of 1 US thousand at present? He will get 83,000 Indian rupee if he comes to India, and he will spend 83,000 on hotel charges, transportation, food, buying goods, etc. Suppose the value of Indian currency appreciates. What it means? Appreciates. Appreciates means less amount of domestic currency will have to be paid to purchase another currency. Suppose the value of Indian currency has appreciated and now 80 rupee are equal to 1 US dollar. The value of Indian currency has appreciated. Now less amount of domestic currency is equal to the same unit of another currency. Here in this example we have assumed that the value of Indian currency has appreciated. Now the same US citizen, he is now deciding to visit India and he is having the same budget of 1000 US dollars. What he will get after currency appreciation of Indian currency? Indian currency has appreciated, the budget is same $1000, and now if a US citizen wants to visit India after the appreciation of the currency of India, he will get only 80,000 Indian rupee. That is, in return of the same amount of US dollars, US citizen will have less amount in Indian currency when converted into Indian currency. So if there is currency appreciation in any country, it reduces inbound tourism. Because the US citizen may think that they may have other options, better options than India. That is, foreigners may think that they have other options where the value of their currency is more. They can visit other countries for travel purpose or for holiday purpose. Now the other impact on tourism is it increases outbound tourism. What it means? We have firstly understood that foreigners are visiting India. Now there are also persons who want to visit from India to other countries. They also want to visit. They also want to have fun, to enjoy life. So earlier, when the value of 83 Indian rupee was equal to 1 US dollar, and we take same example that if the Indian was having 83,000 rupee and he was getting 1000 US dollars. Suppose the same now the Indian wants to visit US. Now with the budget of 83,000 Indian rupee, he was getting 1000 US dollars for spending in USA. Now the value of Indian currency has appreciated. What happens? Now with the same budget, 83,000 Indian rupee, he will be getting more than 1000 US dollars. that is in excess of $1,000 he will be getting, or he will have to pay out only 80,000 Indian rupee to get 1,000 US dollars after the appreciation of Indian currency. If he decides to spend same amount 83,000, he will get more than 1,000 US dollars. But if he decides to spend only 1,000 US dollars, he will have to pay less in domestic currency. So currency appreciation reduces inbound tourism and it also increases outbound tourism. It has two effects on tourism. Now we come to the impact of currency depreciation on tourism. Currency depreciation makes a country less expensive for foreign tourists. We understand the same with the help of example. Suppose at present 1 US dollar is equal to 83 Indian rupee. Now suppose the value of Indian currency depreciates. What it means that after depreciation, if a foreigner visits India, he will get 85. Earlier, if a foreigner visited India, he was getting only 83 rupee in return of 1 US dollar. But as the domestic currency of India, that is the Indian rupee, has depreciated, the same US citizen will now get more currency of Indian rupee for the same amount of US dollars. So it increases inbound tourism as the US or the foreigners will now be in a position to get the more amount of the depreciated currency. It will improve the tourism in that country where the value of currency has depreciated. If the value of Indian currency has depreciated, the tourism will increase, inbound tourism will increase. It also affects the outbound tourism. It reduces outbound tourism. What it means, when the foreigners are visiting a country, the people from our country also would like to make visits to other countries for travel for fun or other purpose. So earlier, when there was no appreciation or depreciation, the 1 US dollar was equal to 83 Indian rupee. But now, as the value of domestic currency has depreciated, now 1 US dollar is equal to 85 Indian rupee. It means that after currency depreciation, the Indian will have to pay more to get the same amount of other currency. Earlier, if a citizen of India wanted to purchase 100 US dollars, he used to pay 8,300 Indian rupee. But now to get same 100 US dollars, they will have to pay out more, 8,500 Indian rupee. So it reduces outbound tourism because the people may either decide not to go abroad because they may not have the budget which is may be necessary to meet the expenses in the case of depreciation of their domestic currency, because the foreign currency has appreciated, value of foreign currency has appreciated and the value of domestic currency has depreciated. So currency depreciation increases inbound tourism and it reduces outbound tourism. Now we will go through real life examples of currency appreciation and currency revaluation. Firstly, the real life example of currency appreciation. From around 2003 to 2008, Australia experienced significant currency appreciation. That is, the value of their currency appreciated in Australia. Why? Because there was high GDP growth, there was booming mining sector, and there were robust exports, that is good exports, good in good quantity. The exports were there of coal and iron ore. It was having those reserves, and so it was exporting. Political environment in that country was very stable. The interest rate policy of the Australian central bank was also very favorable. So all it resulted into the appreciation of the currency of Australia during the period 2003 to 2008. Now we will understand the case of currency revaluation of China's yuan currency. China's yuan currency from 2005 to 2010. Prior to 2005, the China was adopting the policy of fixed exchange rate system of its currency vis-a-vis the US currency. That is, it used to peg its currency, that is yuan, with respect to US dollar. That is, it was taking steps to ensure that the value of its currency remains stable with respect to US dollar. Then facing the pressure from US and other trading countries, because the China was having a very big trade surplus. So facing pressure from US and other trading partners, the China government in 2005 abandoned the policy of fixing its abandoned the policy of pegging its yuan against US dollar. So when it's abandoned the policy of pegging yuan against US dollar, then the currency of its China revalued. Initially, it was around 2.1% when it initially increased the value of its currency, and between 2005 and 2010 the currency was revalued many times by the Chinese government, and during the whole period of this 2005 to 2010, about 30% appreciation in the value of currency of China was there. Approximately 30% increase in the value of yuan was there. When the value of its currency has increased, it had its own impacts. It reduced the trade surplus with respect to several countries. That is, it was China was exporting in large number to certain countries and importing less. So it reduced the trade surplus position with respect to many countries. It also increased the imports because the cheaper imports helped Chinese people to control inflation, and it also improved the standard of living of Chinese. Increased imports. Exports were adversely affected in case of currency evaluation by China because the exports became costlier for the foreigners, and those industries which were exporting goods to, in other words, the export oriented units were badly affected, and there were job losses also in export oriented sectors. Then there was also pressure on the exporters to improve their performance and to concentrate on innovation so that they can remain competitive in the market. So we have understood the real life examples of currency appreciation and currency revaluation. Now the topic before us is understanding currency erosion, devaluation versus depreciation. First difference we will understand on the point of definition. In case of devaluation, it is the deliberate or official reduction in the value of a currency relative to other currencies by the government or central bank. What it means? We are living in India and approximately 83 Indian rupee are equal to 1 US dollar. If the government or the central bank of India decides to reduce the value of the Indian currency, then it is devaluation. Suppose it decides that from now onwards 90 Indian rupee will be equal to 1 US dollar. It is devaluation. This decrease in the value of Indian rupee vis-a-vis other foreign currencies by the government order or by the order of the central bank of the country is devaluation of the currency. Here, external forces such as demand and supply, etc., are not the reason for the reduction in the value of the currency. The value of a domestic currency has decreased only by government order. This is devaluation. Official order is there to reduce the value of a currency. On the other hand, if the value of a currency depreciates in comparison to other currencies by the forces of demand and supply, then it is depreciation of the currency, where the market forces of demand and supply come into picture and the value of a currency decreases. It is depreciation. Exchange rate system. Devaluation occurs under a fixed exchange rate system. Fixed exchange rate system means where exchange rates are predetermined and the government intervenes to maintain that rate. We take the example, suppose if the government of a country decides, suppose a European Union, we are taking the example simply, that if European Union decides that 1 euro should be equal to 1 US dollar and it should remain somewhat as it is, and to maintain that balance it will be taking steps that the one value of 1 euro remains equal to 1 US dollars. So this is the fixed exchange rate system. So typically occurs, and this devaluation occurs under a fixed exchange rate system where the exchange rates are predetermined and the government intervenes to maintain that rate. Suppose if the value of euro increases and the European Union is following fixed exchange rate system, suppose here 0.9 euro becomes equal to 1 US dollar, the government of the country may reduce the value of its currency to ensure that it again becomes equal to 1 euro is equal to 1 US dollar. Then depreciation. Depreciation of the currency occurs under a floating exchange rate system. When the demand of the currency falls, when the demand of anything in the market decreases, what happens? The price of that goods decreases. In the same way, in the foreign exchange market, when the demand of a currency decreases, the price of that currency also decreases. So this is the depreciation, and it occurs under a floating exchange rate system. Now, what is the cause of devaluation? The cause of devaluation may be government policy decision. The government of the country may have decided that it wants to make exports cheaper and imports more expensive, so that it may improve the trade balance. On the other hand, depreciation of the currency may be caused by the change in supply and demand of the currency, domestic currency. There may be negative outlook, economic outlook of the country, economic performance of the country is not good. There is political instability in the country, and the speculative investors also believe that the value of the currency is likely to depreciate in the near future, so they will offload their domestic currency, so it will result into the depreciation of the currency. Speed. Devaluation is a one-time exercise. The government may have decided that it wants to reduce 10% reduction in the value of the currency. It is a one-time decision. The government of the country may decide any percentage, 1%, 2%, 3%. And this is a one-time devaluation of the currency, one-time reduction in the value of the currency. This action has immediate impact. If suppose at present 80 Indian rupee are equal to $1, and if the government of India decides that it wants to devalue its currency by 10%, then what will happen? Immediately 88 Indian rupee will become equal to $1. Impact is immediate on the exchange rate. However, in the case of currency depreciation, the depreciation of the currency can be gradual or rapid depending on the underlying market forces. The impact of depreciation might not be as dramatic and immediate as the government driven devaluation. It means that in the case of devaluation, there was immediate reduction in the value of the currency. That is, if the government decides at this point, there will be immediate reduction in the value of the currency. But in the case of depreciation, the value of the currency depreciates slowly and slowly, or it may be rapid, but not as fast as happens in the case of devaluation of the currency, because in case of devaluation, it is by government order and it has immediate impact in the foreign exchange market. Now, appreciation of value. In the case of devaluation, it is possible for the government to raise the value of the currency after it has been devalued. It means that today the government decided to devalue its currency. Now, after some months, it decides to raise the value of its currency. It may do so. It may raise the value of the currency, but it is a very complex and challenging process to raise the value of the currency once it has been devalued. That is, if today 80 Indian rupee are equal to $1, and there was 10% reduction, and 88 Indian rupee was equal to $1. But after some months, the government decides to reinstate that original position. It wants to increase the value to 80 Indian rupee equal to $1. It may not be as simple. The value of it is not possible to increase the value of the currency in one shot. The devalue is simple. To increase the value is not as simple. It is a challenging process. In the case of depreciation, once the currency has depreciated, it is possible that it may appreciate, but this is not a guarantee. If there is political instability in the country, the foreigners are not interested to make investment in the country, then what will happen? There will be no demand of the domestic currency in the foreign exchange market. However, if the demand of the currency increases, the outlook of the country improves, economic performance improves, the investors think that it will be worthwhile to make investment in the country, the demand of the domestic currency will increase and the value of the domestic currency will increase. Next is control. In the case of devaluation, government has direct control over the timing. It may decide that it will devalue its currency tomorrow or next week or on a particular date. The government decides what is the timing of devaluation and what is the extent of devaluation, whether it wants 1% reduction, 2%, 3%, the government decides timing and percentage of extent of reduction in the value of the currency. Government decides. In the case of depreciation, it is the demand and supply in the foreign exchange market which decides the depreciation. For a larger market forces mostly dictate the pace and extent of depreciation. That is, the demand and supply mostly decides what will be the depreciation, whether it will be fast, gradual, or what will be the extent of reduction in the value of the currency. With the government having limited direct intervention, that is, in case of depreciation of currency, the government has very little intervention, direct intervention. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.